Hello, everyone, and welcome back to our University of Missouri Extension leasing series designed to help farmers and property owners with leasing arrangements. I'm Julie Harker, news strategist with Kaffner Extension. Today, we have a slight change on our sixth program in our series. I have with me two guests, Ray Massey and Juo-Han Tsay, to introduce another type of lease and to make some conclusions and comparisons on land leases for crop production. As always, type any questions you have in the chat box at the bottom of the screen, and we'll get to them at the end. Ray was introduced during our first session talking about property owners and tenants. Ray, welcome back. Give us a brief introduction of yourself again for the audience.
All right, thank you. And I'd just like to welcome everybody on this Valentine's Day. I know this is probably not what you normally think of as happening on Valentine's evening, but I appreciate you joining us. So I've been with the MU Extension now for 28 years. And I've been involved in a lot of leasing activity, leasing questions. And our topic tonight of flexible cash leases is one that I'm exploring recently in a research project I'm doing to see how leasing arrangements affect the adoption of conservation practices.
Very good. Well, Juo-Han, we're so excited to have you with us. You are new to us, so please introduce yourself.
Hello, everyone. My name is Juo-Han Tsay. I'm currently a postdoc at the University of Missouri working with Food and Agricultural Policy Research Institute and the Rural and Farm Finance Policy Analysis Center. I was raised by my grandparents on their pineapple farms in southern Taiwan. I came to US in 2014 for my master's degree at the University of Wisconsin-Madison, and I got my PhD degree at the University of Illinois. My research focuses on agricultural policy, such as commodity program and crop insurance policy, as well as farm and rental management. When I was in University of Illinois, I worked with Farm Doc Extension team. I wrote several Farm Doc articles and helped the team with the materials related to the policy and the leasing. One of my research projects in Illinois is estimating the proportion of the government payments accrued to Illinois landowners through the cash rental rate.
All right, so in this series, we've explored cash leases and crop share leases. Some say that cash leases put too much risk on the tenant and that share leases are too complex for both the tenant and the landowner. One way to resolve these problems is a flexible cash lease. What exactly is a flexible cash lease?
Yes, a flexible cash lease is sometimes called a variable cash lease or a hybrid lease. What they do is allow the rental payments paid to the landowners to adjust based on the economic circumstances. A share lease, which you mentioned was discussed last week, also allows the rental payments to adjust given the circumstances. But some property owners may not be comfortable with paying some of the expenses or input costs, or not comfortable in marketing the crop they receive in a share lease. So a flexible cash lease has been designed to simplify the share rent lease. The final rent is share of the revenue or other agreed upon factors. But the inputs are not shared, and the property owner does not have any responsibility to market their grains after the harvest time.
Okay, well, this sounds like a pretty interesting modification of the leases that we've discussed so far. Let's take a look at this video to get some more information about flexible cash leases.
One of the challenges of developing a satisfactory lease is mitigating risk. Typically, reward increases with greater risk. Each party in a lease has a different perception of and tolerance for risk. It may require hard work to arrive at a fixed cash rental rate satisfactory to both the landowner and the tenant. They do not split the risks and rewards between the two parties. Regrets may arise when prices or yields deviate significantly from what was expected. Share leases require more attention during the production season as landowner and tenant are sharing input costs and grain revenue. Deviations from expected yields or prices are shared between both the tenant and the landowner. The cash outlays required from the landlord and the amount of communication between parties with share leases discourage some from using them. Flexible cash leases or variable leases are a hybrid of fixed cash leases and share lease agreements. They were developed to try and incorporate the risk-return principle into leases without the major challenges of share leases. Landowner regrets from having a rental rate that does not obtain some occasional windfall profits in agriculture are lessened with flexible cash leases. Flexible cash leases also keep tenants from overpaying when revenue from farming falls below expectations. Flexible cash leases share both the risk and the occasional high return from farming. Flexible cash leases can account for changes in yield, commodity price, total revenue, or some estimate of margin. Flexing on total revenue is the same as flexing on both yield and price. While many ways to flex a lease exist, we will focus on using total revenue. Flexible cash leases consist of a base rent paid to the landowner plus an adjustment upward if crop revenue exceeds the amount of the base payment. A clear understanding and agreement on the base rent and the adjustment factors promotes a satisfying lease. A maximum rental payment is also common in flexible cash leases. This may limit the adjustment to a certain dollar amount or to a percentage of the base rent. Maximum rental payments prevent the tenant from having cash flow challenges resulting from paying a high final rent amount. Typically, the base rent is the lowest amount the property owner can expect to receive. The final rent adjustment is a bonus paid in addition to the base rent. Not setting a guaranteed base rent can cause the lease to be viewed as a share agreement for tax and government program purposes. Most businesses using flex leases prefer to have their lease viewed as a cash lease. Several factors influence the choice of the base rent. One of the simplest ways to set the base rent is to set it at 60 to 80% of a typical fixed cash rental rate. Because the base rent is less than a typical cash rent, the landowner has the risk of lower income in some years. The landowner typically receives the base rent at the beginning of the production cycle, say March for corn and soybean production. The final rent payment is made after yields and prices are known for certain. One way to adjust the rental rate for yield and price changes is to determine a percentage of revenue that the property owners will receive. At harvest time, revenue is estimated by multiplying actual yield by an agreed-upon price. The final total rent is calculated by multiplying the estimated revenue by the agreed-upon percentage. The harvest time payment is the final total rent minus the base rent already paid to the property owner. Many ways exist for creating flexible cash leases. Several of these can be viewed in Fixed and Flexible Cash Leases, published by the North Central Farm Management Extension Committee on aglease101.org. Iowa, Illinois, and Missouri Extension also have guidance on how to flex cash leases. The keys to a satisfying flexible rent are agreeing to a base rent, using a well-researched method of adjusting that rent, and understanding what data will be used to make the adjustment. Well-crafted flexible cash leases can remain in effect for many years, allowing risks and returns to be shared between both landowner and tenant.
That was a lot of good information. The idea of a base rent that can be adjusted seems like a good way to accommodate the uncertainties of ag production. The two components of a flexible cash lease are the base rent and the adjustment for revenue. Please explain the base rent a little bit more for us.
Yes, so the base rent is often a percentage of average fixed cash rent would be. For example, if an average fixed cash rent is $150, a base rent would be set at maybe $100 or 2/3 of the fixed cash rent. But this percentage is not established by law. It is established in negotiation between the landowners and the tenants. So a fixed cash rent of $150 could also result in a base rent of $120 if that is what the landowners and tenants agree to.
Yeah, Juo-Han has just indicated that you can use either a dollar amount or a percentage amount. But the base rent typically is lower than the fixed cash rent. And what's happening there is the landowner's giving up some certainty in rent for the right or the privilege of benefiting from a higher rent when prices and or yields are really good. And this is just part of the risk return principle that we've talked about in almost every one of the weeks that we've already had leasing seminars. So that's what we're trying to do here.
So the adjustment to the total rent, can you explain that a little bit more? Like, what are some important principles to consider?
So the video today mentioned only to adjust the rent based on the revenue. The adjustment, however, can be based on just the yields or just on the commodity prices. But there are some important reasons when adjusting just on yields or prices is not optimal. The yield and price can be negatively correlated, meaning that when one is down, the other is up. However, what the tenant and landowners are really concerned about most of the time is the revenue, which is the yields times the price. So in the video, we recommend a flexible lease adjust the rent based on revenue. And what are the yields and prices based on? The yields will be reported by the tenants to the landowners. This requires that the landowners trust the tenants to accurately report the yields. Yields can also be verified by the weight tickets at the local elevators or beam measurements or even properly calibrated yield monitor data. And after harvest time, the tenants should be able to give an accurate measure of yields to the property owners. And then this yields needs to be multiplied by some agreed upon of discovering prices. There are several ways to determine the prices, but we recommend to use the USDA Risk Management Agency RMA report of the harvest time price. The price in their report is the average price of corn December futures contract or November soybeans futures contracts, which are settled in October. We recommend this because it is an objective measure of price that can be easily obtained. And most farmers insure their crops, so they are well aware of the harvest time price published by the USDA RMA.
Yes, that's great information. I would add, we're talking about what price to use. I would use the data that is used to determine the percentage of revenue that's going to be shared between the landowner and the tenant. So you want to keep data consistent when you decide what percentage of revenue will be shared with how you determine what revenue is. So in Missouri, we're wrapping up a publication on the average percent rate paid by tenants to landowners. And we're, for the most part, using USDA county yield data and RMA harvest time price that they reported to calculate that revenue. And so if you were to use our estimates, you would probably want to use the RMA harvest time price. But then again, you are going to use the rental or the yield that you would probably, that you would actually have on your farm. So the tenant would need to report both corn and soy. Oh, I'm sorry, I messed up.
That's okay.
You're just looking at, I'm just looking at how you do that. You've got these yields that you're going to need to report from actual yield, but you use a price from RMA. If you use the publication that we're almost ready to publish on flexible rents.
Yeah, and Ray is actually correct that for the rental factors, we are calculating different for corn and soybeans. So usually you need to have the rental factors for corn and rental factor for soybeans. And the corn rental factors usually tend to be lower than the soybean rental factors. So the tenant would need to report both corn and soybean yields and the percent of acres planted for each crop. In other words, you would like to have a soybean rental factors multiplied by the soybean revenue and the corn rental factors multiplied by the corn revenue.
Wow. So this sounds a little complicated, is it?
Yes, it is. Establish any leases is complicated. It really requires the negotiation between the landowners and the tenants. But once the lease agreement has been made, the calculations are quite simple. The key factors or the key to successfully having a flexible cash lease is in coming to agreement on all the data used. Determine what the base rent will be, what percent of revenue will be used, determine the final lease payments, and the price would be used, what price will be used each year. And I should also make it more clear that the final rent payments often also has a maximum value that is negotiated. This protects the tenants from having an unusually large payments due right after the harvest times. So while the crop may be out of the field, it has not always been sold by then. So a good marketing strategy might postpone the sale, which will affect the cash flow. The tenant can know the maximum amount of the money he or she will owe to the landowners and use that to determine his or her crop marketing plan.
So Juo-Han indicated that it's complicated, and it is, but a flexible cash lease is less complicated than a share lease. And it's only modestly more complicated than a fixed cash lease. So all leases are complicated. But what we're wanting to do with the remainder of this session, because we're not going to have a second video like we normally do, is we want to compare the different types of leases that we've been talking about: the fixed cash rent, the flexible cash rent, and the share lease. So as we do that, I want to get back to the final lease payment that Juo-Han mentioned. And it's a percentage of the calculated revenue for that year. But since the tenant has already paid a base rent, what's going to be paid at the end of the year is the percentage of revenue minus that base rent. And so you have both a spring base rent payment and a fall adjustment payment that the tenant would give to the landowner.
Okay, so payment is one of the big concerns with leasing. You mentioned the flex lease payments. Can you revisit rent payments for both the fixed cash lease and the share lease?
Yes, so the fixed cash rent lease is the tenant pays the landowners a fixed amount of cash rent per acre. So both tenants and landowners know the payments at the beginning of the year. The tenants receive 100% of the crop revenue and the government payments such as ARC and PLC, and pays 100% of the crop machinery and labor inputs. The timing of cash rent payments may vary, but the common arrangement has the tenants paying a portion of the cash rent in the spring and the final portion of the rent being paid in the fall.
And so, again, something that we've already talked about in the previous sessions, but any rental payment is the negotiation tool. And one of the interesting things I have found with regard to a fixed cash rental payment is you can pay them all in the spring, or you can pay it some in the spring and some in the fall. But paying it all in the spring gives peace of mind to landowners. And so you might be able to actually reduce the rental payment to a landowner by giving them peace of mind that they're going to get it all, or by paying it up front. This is really what's in economics we call discounting. So $1 today is worth more than $1 6 months from now. So if in the negotiation process, the landowner would say, hey, I want it all up front, or the tenant would say, I'm able to pay it all up front, but I need to take a discount or something of that nature. All that needs to be done is the tenant says, how much would it take for me to borrow this amount of money, the fall lease payment, borrow that money from the bank, how much would it cost? And if I can get a discount equal to or larger than that from the landowner, I'll pay it all up front. And so again, we're just looking at negotiation points here, particularly with rental rates.
Yeah, I think Ray is correct that the value of the dollar is very important in the leasing. And for the share rent lease is a lease that where tenants and landowners will share in the revenue and the cost. And for example, the most common share rent lease in northern Missouri may be 50 and 50, means that you have 50% in the revenue and 50% in the cost, but this can be changed too. In Southwest Missouri, lease with 1/3 to 2/3 ratio of shared revenue and the cost may be pretty common. So it really depends on what the landowners and the tenants each contribute to the production. In the share and lease, the revenue include crop revenue, commodity payments, and crop insurance proceeds. The costs are fertilizer, lime, seed, pesticide, drying, storage, and crop insurance premiums if there is an agreement. Landowners does not receive a certain payment and is responsible for marketing their portion of the grain.
Great information all around, and thank you. We do have more questions, so we're going to start with what we have in the chat box, and you guys can decide who answers, or you both can, of course. What proportion of leases in Missouri are flexible cash leases compared to crop share leases?
Let me answer that one. In Missouri, less than 5% of leases are flexible cash leases. They are the smallest percentage of what leasing arrangements are. Share leases, we're going to go probably about 20 or 25% are share leases, and the remaining 70 to 75% are cash leases. So share leases have actually been around for a long time, but they are not as frequently used as an economist would think they should be. So I look at them and I say, why aren't people using these? And there is some complication to it. So that's why we are coming up with a new publication that should be out within about a month that tries to simplify it by just putting it step by step. So it's easier for people to think about.
Very good. All right, our next question is, can this type of rental be used with cattle? Is it slightly different from crops?
Yeah.
I think that it probably would be pretty difficult to use this with cattle. It's always been used, or that I know of, with crops. And that's because it's much easier to know what the yields are and know what the prices are with crops than it is with cattle. So I would, if you wanted to do it with cattle, I'd make sure that you had a well thought out plan.
Yes, and then so because in this flexible cash rent, you calculate the rental factors for the crops that you have. It will be probably a little bit difficult for the cattle, but for the cattle rental lease, Iowa State have a bunch of information for the cattle lease. So if you're interested, you can look at the Iowa State University Extension website.
And I'm going to add one more thing there. 2 weeks from now, the series will specialize on cattle share leasing. So if you're interested in cattle, you definitely want to make sure you're here 2 weeks from now.
All right. Another question, from a legal perspective, are there any advantages or disadvantages to a flex cash lease?
There are, and Juo-Han already mentioned one of them, and that is, how is the rent considered? So the rent is, for a taxable purpose, considered not a material participant. So it's considered passive income. Whereas if you do a share lease, it's not considered passive income. So there's some benefits of having passive income versus having active income. And a share lease, which we talked about last week, you need to make sure, and you put it in writing in your lease contract, that it is not a partnership. And a flexible cash rent is, I don't think it's ever been considered a partnership. It's just sharing the risk and return, but not actually sharing management decisions or anything else of that nature. So those are a couple of the differences legally between the leases.
Okay. Here's another question. As a landowner, how do I navigate a conversation with my farmer about changing up our lease type in the next year? Is there a good time of year? And should I have a mediator involved? And does it make a difference with a verbal versus a written lease?
Wow, yeah, that's a lot of questions, actually.
Yes.
So, when I talk to people, I always say, anytime you're wanting to change something, the person who wants to change it needs to take the initiative to be prepared to talk to the other. So the tenant wants to change it, they take the initiative and they come prepared, meaning they don't just bring it on them without any help. So there's two things that I think are important when you come prepared. One is come early, meaning if your lease ends on January 1st, you're probably going to want to start talking to them about a change in June or July. You need months to work this through. The second thing that you'll want to do to help out is you'll probably want to present them with documentation and a clear picture of what's happening so that they don't have to go explore. If you put it on them to go explore what's the meaning of a flexible lease, they may never get it done. But if you present them with the material and with the plan, let them think about it for a little while, maybe shoot at it and start the negotiation. That's how I would suggest doing it. So plenty of time, come well prepared. And so if there's a good time of the year, really, I think you do want to do it 6 months before your lease ends, so that they have plenty of time to think about it. Juo-Han, do you have any other thoughts on?
Yeah, so based on my experience in Illinois, so there is a statute that you need to notice the farmers, give the notice to the farmers 4 months before the last day of the lease. For example, most of the time, the lease starting in March 1st, that you need to give the notice whether you're going to terminate or not, or you want to negotiate 4 months before, so which will be the last day of the October. And Ray, I remember we have this conversation in Missouri. There's also a certain day of the notice time that the landowner should give the notice, right?
So Missouri is different, and so that's really important to know. If you have land in 2 different states, there's different laws. So the Missouri law for termination of a lease, which if you can't come to an agreement on a change, it could result in a termination. But the Missouri law for a termination of a lease is you have to give them 60 days notice from the time that you agreed to enter into a lease. So let me just work that through. Assume that on January 1st, you agreed to lease your land to a tenant, and he would start that lease on March 1st. You have to give 60 days notice before January 1st, not before March 1st. It's the day in which you agreed to a lease that you have 60 days prior notice required on a verbal lease. If you have a written lease, you can put any date you want in there. But a verbal lease, if you haven't written it down, the state has a contract for you and it says 60 days.
All right, good stuff. All right, I have a couple questions. You guys did talk about the disadvantages and advantages from a legal perspective on the flex leases, but what about just the differences, pros and cons of the 3 types, the fixed cash rents, the share rent, and a variable cash rent lease?
Yeah, so this is kind of refresh people's memory here. So one of the characteristics of fixed cash rent we mentioned is landowners know the amount of income they will receive and the timing of when they will receive that amount of income. And the landowner does not need to worry about marketing grain, paying their share of the crop inputs and the decisions for crop insurance or commodity program. However, fixed cash rent does not adjust quickly as current economic conditions. It is difficult to adjust rent, particularly when a certain economic change happened.
And regarding that adjustment of rent, again, the flexible cash lease adjust rent faster than a fixed cash lease. A share rent is always an adjustable rent, so that's not a deal. But I might mention one of the common questions, the questions I get asked most often is, hey, what is the average rental rate in my county? And I try to communicate that whenever we take a rental rate survey, which we do every couple of years, we are getting responses from people that have negotiated their rent this year and 2 years ago and 3 years ago and 4 years ago and 5 years ago, meaning the person that negotiated their rent 5 years ago and hasn't changed it, they may still be responding to our survey. And therefore, when we average all those up together, the average most likely is going to be lower than the going rent. particularly if rents are increasing. Now, if rents happen to be decreasing for some reason, which they do on occasion, the average may be actually higher than the going rate. But all of these adjustments are things that we can talk about more later.
Yeah, and so for the share rent, the lease will adjust to current economic conditions. When the price is up, input costs are increasing by recent years, the returns to landowners and tenants will reflect accordingly. And under share rent, landowners has more involvement in the business. Contrary to the fixed cash lease, landowners in the share rent lease bears more risk. And particularly landowners needs to make decisions about the marketing. And landowners also doesn't have a payments until the end of the harvest time when the revenue is received. The variable cash rent lease we introduce here today is a cash rental lease moving away from the fixed cash rental lease and moving towards the share rental lease. The characteristic is the rent adjusts more quickly to current economic condition compared to the fixed cash rental lease. The variable cash rental lease does not have to be renegotiated every year as well, because you already built in these fluctuations in the revenues. And there will be more negotiation between landowners and the farmers than the fixed cash rental lease. Both sides need to decide the base rent, price, and rental factors that are going to be used in the lease.
Excellent information. Thank you both, Juo-Han and Ray, for this great information. If anybody has any more questions, you can reach out to them. We have their email and phone numbers on the Canvas site for any additional questions that you might have. And I want to remind you that next week we'll be back at the same time. I will have Joe Horner as the guest, who will discuss energy leases. Until then, have a good week, and thanks for joining us.